Hi, this is Professor Cataldo, and I'm going to walk you through some PowerPoints with some basic accounting transactions and take them through financial statement preparation. This is the type of material that would be covered in an introductory chapter, Chapter 1 of an introductory financial accounting course. First, a little bit of a review of the basic accounting equation. Assets equal liabilities plus owner's equity, sometimes referred to as equity. So I have assets on the left-hand side, liabilities and equity on the right-hand side. Notice all receivables are assets, all payables are liabilities. This is a slightly expanded version. I have prepaid accounts that have been added to the assets section, but it's not essential that you understand that to understand these PowerPoint slides. Prepaids are usually covered in the second chapter of an introductory financial accounting text. Here are 5 transactions. Notice the accounting equation at the top. Assets equal liabilities plus equity. Cash is an asset, supplies, inventory or supplies is an asset, equipment is an asset. Look at liabilities. Accounts payable and notes payable are liabilities. And in the simplified version, common stock is equity. Now I'm just going to walk through these 5 transactions. There is no description of these transactions, but I think you'll be able to follow. Remember, for each and every separate transaction, assets equal liabilities plus equity, or A equals L plus E. So, first transaction. It looks like I formed the corporation by writing a personal check and depositing it in a brand new corporate checking account. And in exchange, common stock in the corporation was issued to me. Let's assume I'm a sole shareholder. Second transaction. It looks like I wrote a check and reduced my cash balance to purchase some supplies. Third transaction. It looks like I wrote a check and paid cash for equipment. Fourth transaction. It looks like someone extended credit to me and allowed me to purchase supplies and equipment on accounts payable. Fifth transaction. It looks like I went to the bank and signed a promissory note and borrowed $4,000, and that $4,000 went into my corporate checking account. What you want to pay attention to in each transaction is that each and every transaction, A equals L plus E. Assets equal liabilities plus equity. You should get to the point in your first chapter of an introductory financial accounting course where you can simply look at these numbers and the categories and the classification, and you should be able to figure out what the transaction is. I have, again, skipped the explanation of the transaction. Now this is going to be a little bit more fully developed equity section. We're going to look at transactions involving revenue, expense, and dividends. So there's a 6th, 7th, and 8th transaction. These are a little more complex. Notice how the equity side, I've expanded. It's not just common stock over there. It's also revenue, expense, and dividends. Just look at the numbers over here under these headings. Revenues increase equity, see the positive 3,000. Expenses decrease equity, see the bracketed or negative 800. And dividends decrease equity, see the bracketed or negative 500. Let's walk through the transactions, see if they make sense. Transaction 6. I increased cash and I increased revenue. Oh, I must have had some sales or provided some services. A equals L plus E. 7th transaction. It looks like I wrote a check out of my corporate checking account to pay some expenses. It doesn't really matter what expense they are. It could be rent, it could be salaries, it could be utilities. And number 8, it looks like I wrote a check out of the corporate checking account to pay dividends to shareholders. Notice again, dividends and expenses decrease equity, Contributed capital or common stock and revenue increase equity. This is what the financials look like, using the same fact pattern, the same numbers. I had consulting revenue of $3,000, salaries expense of $800, so I had net income of $2,200. That's the income statement for the month. Right below it, the retained earnings statement for the month. Let's assume it's the first month of operations. 0 beginning retained earnings. Add the net income, see how it flows. Flows right out of the income statement into the statement of retained earnings. Paid out some dividends to shareholders, and I retained $1,700 of the $2,200. And notice how the retained earnings balance at the end of the period flows into the balance sheet over on the right-hand side. And the balance sheet is a financial statement that shows the financial position of the firm at a point in time, because there's just a date there. Notice the income statement says for the month ended. The statement of retained earnings says for the month ended. The balance sheet gives a precise date, a snapshot, a point in time. Thank you.